Welcome to StockTok's deep dive into Airbus SE. Airbus is the world's largest commercial aircraft manufacturer by revenue, competing alongside Boeing to build and sell jetliners to airlines worldwide. The company also operates a significant defense and space segment, making it a diversified player in aerospace and a bellwether for global economic health. Over the trailing 52 weeks, the stock has ranged from a low of $43.36 to a high of $64.35. As of May 11th, the stock is trading at $51.79, positioned near the lower end of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Airbus generates revenue through three main streams: commercial aircraft sales, helicopter manufacturing, and defense and space contracts. The commercial business is the largest profit driver, but it is also capital-intensive and cyclical. Airlines order jets when economies are strong, then cut orders during downturns. Airbus has a structural moat rooted in the enormous sunk costs required to design and certify commercial aircraft, regulatory approval barriers, and long-term customer relationships with major carriers. However, competition from Boeing, supply chain constraints, and labor inflation present real pressures. The StockTok score for Airbus stands at 29 out of 100, signaling caution across the board. Valuation scores 6 out of 20, financial health 10 out of 20, profitability 4 out of 20, growth 9 out of 20, and smart money interest 0 out of 20. This is a name that requires serious scrutiny before committing capital. Now, valuation. The question every investor has to answer: are you paying the right price? Airbus trades at a trailing 12-month price to earnings multiple of 27.22 times. For context, a typical industrial manufacturer trades in the high teens to low 20s range. That puts Airbus at a meaningful premium to the broader sector. The forward price-to-earnings multiple of 25.47 times suggests the market expects modest earnings improvement, but still at an elevated multiple. The price-to-earnings growth, or PEG ratio, stands at 1.03. A reading above 1 indicates the stock may be expensive relative to its growth rate. At an enterprise value to EBITDA multiple of 13.3, Airbus commands a valuation that reflects confidence in its cash generation ability, though the EBITDA margin, as we will see, is under pressure. Our DCF model suggests the stock is trading at a 0% margin of safety, meaning the market is pricing in full value with zero discount for downside risk. That is a yellow flag. Wall Street analysts, based on a consensus of 4 analysts, have a mean price target of $58, implying upside of approximately 12% from current levels. The high target sits at $75 and the low target at $51, a wide dispersion suggesting analysts lack conviction. Taking both signals together, a reasonable fair value range in our view sits between $52 and $58. That overlaps closely with current price levels, leaving little margin of safety should earnings disappoint. Market sentiment around Airbus leans neutral, insufficient recent news to build a strong bullish or bearish case. From a valuation standpoint, we see limited upside and material downside risk. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point health checklist developed by accounting professor Joseph Piotroski to spot financially healthy firms, comes in at 6 out of 9 for Airbus. That is a below-average score, signaling some accounting and operational deterioration. More concerning is the Altman Z score, a bankruptcy risk model that combines 5 financial ratios. Airbus scores 1.76, which places the company in the distress zone. Below 2.1 suggests elevated bankruptcy risk. This is a red flag. On the positive side, the company maintains a cash-to-debt ratio of 1.66, meaning it has more cash than debt on its balance sheet in absolute terms. Interest coverage, operating income divided by interest expense, stands at 6.8 times. That means Airbus generates $6.8 of operating income for every dollar of interest owed. In absolute terms, that is serviceable, but not fortress-like. The current ratio, a measure of short-term liquidity, is 1.16. A ratio above 1 indicates the firm can cover short-term liabilities with short-term assets, but at 1.16 the cushion is thin. Debt to equity stands at 0.42, a moderate leverage level. The underlying concern is not leverage levels, which are reasonable, but rather the deteriorating profitability that makes servicing debt increasingly difficult. The balance sheet has adequate buffers, but earnings power, which we will explore next, is where the real stress shows. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, represents the profit generated on every dollar of capital invested in the business. Airbus return on invested capital sits at 3.88%. For an industrial company with a structural moat, a return on invested capital below 5% signals poor capital efficiency. The company is not generating sufficient returns on the billions of dollars locked into inventory, receivables, and fixed assets. Gross margin, the profit remaining after subtracting cost of goods sold, stands at 14.94%. For aerospace manufacturing, which involves complex supply chains and labor costs, gross margins in the mid to high teens are typical. 14.94% suggests pricing pressure or rising input costs. Operating margin, the profit remaining after operating expenses, is 7.13%. That reflects a lean operation, but also leaves little room for error. Net margin, or net income as a percentage of revenue, is 7.11%. When you combine operating margin at 7.13 with a 7.11% net margin, you see that tax and interest are nearly breaking even. There is no tax benefit or interest deduction providing relief. Free cash flow margin, which measures cash left over after capital expenditures, is just 2.72%. That is particularly concerning because aerospace is notoriously capital intensive. With free cash flow margin at 2.72%, the company is converting very little of each revenue dollar into cash available for dividends, debt repayment, or growth. Return on equity is 22.82%, a respectable figure on the surface, but this appears inflated by financial leverage rather than underlying business strength. Return on assets of 3.98% is weak. In aggregate, profitability is the weakest link in the Airbus thesis. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 7.7%. Over the trailing 5 years, revenue growth is 8.4%. In absolute terms, single-digit growth is modest for an industrial manufacturer, especially one with a global moat. The aerospace cycle is lumpy. Demand surges when airlines invest heavily in new fleets, then flattens during recessions or regulatory disruptions. Book value growth, which measures the equity capital base, is 26.3% over 3 years. That number is elevated and suggests the company is retaining significant earnings or marking assets higher, rather than organically expanding shareholder equity. The dividend yield is 1.77%. That is a modest yield for an industrial name and reflects capital constraints. The latest quarterly results, reported approximately 13 months prior, showed a significant challenge. Revenue contracted by negative 51.3% year-over-year to $12.65 billion, driven primarily by lower delivery volumes and adverse timing on military contracts. While operating income of $190 million and net income of $590 million suggests the company remained profitable, the revenue cliff is alarming. Forward guidance and commentary from management will be critical to assess whether that represents a temporary disruption or a structural shift in demand. The next earnings date is April 28, 2026. Watch that report closely for evidence of demand stabilization. In our view, growth dynamics are not compelling. The company is managing a cyclical business in a down cycle, with limited visibility to when demand normalizes. Now let's talk smart money. What institutional capital is actually doing with this name? Zero top-tier hedge fund gurus currently hold Airbus SE in their portfolios. That is striking. Investors like Joel Greenblatt, David Tepper, or Lee Cooperman build concentrated positions only when they have conviction in a thesis. The absence of any guru holder signals that the most sophisticated, long-term oriented investors see limited opportunity here. On the institutional side, only 0.2% of 13F filers, that is investors managing money on behalf of institutions, have net bullish positions, meaning they are buying more than selling. For perspective, when an industry reaches 50% of filers in net buying mode, that signals strong institutional appetite. 0.2% is essentially institutional indifference or outright avoidance. Insider ownership stands at 0.0%. Management owns virtually no shares of their own company. In 23 years of studying corporate governance, research consistently shows that insider ownership above 5% correlates with better long-term stock performance. Managers with skin in the game make different capital allocation decisions. 0% ownership suggests misaligned incentives. Insider transactions over the trailing 3 months show 0 buys and 0 sells. There is no corporate buying activity and no insider selling pressure. But the absence of buying is the concerning signal. When management believes the stock is undervalued, insiders will accumulate. The lack of any insider activity implies management is not signaling conviction. In aggregate, smart money, defined as long-term hedge fund capital, institutional momentum, and insider action, is giving Airbus a 0 rating. That is the weakest signal in the StockTok framework. And finally, the verdict. Let's bring it all together. On valuation, Airbus trades at a full to premium multiple with a 0% margin of safety, leaving no room for disappointment. On financial strength, the Altman Z score sits in distressed territory, signaling rising bankruptcy risk despite adequate near-term liquidity. On profitability, margins are contracting and return on invested capital is far below cost of capital. The company is destroying shareholder value on an incremental basis. On growth, single-digit revenue expansion and a recent revenue contraction of 51% expose cyclical weakness and demand uncertainty. On smart money, 0 top-tier gurus, essentially 0 institutional net buying, and 0% insider ownership all scream that sophisticated capital is absent from this name. In our view, a fair value range for Airbus SE sits between $52 and $58, representing downside of approximately 0 to 5% from current levels. That range reflects both the DCF analysis and Wall Street consensus, but it provides minimal margin of safety. The latest quarterly results, showing a significant revenue contraction, reinforce rather than challenge the bear case. Production delivery timing and cyclical demand remain profound headwinds. Taken as a whole, the fundamentals paint a picture of a cyclical industrial manufacturer facing simultaneous pressures on profitability, growth, capital efficiency, and investor appetite. Wall Street remains mildly constructive, but the absence of smart money conviction is a material counterweight. In our interpretation of the publicly available data, the setup does not warrant new capital allocation at current levels. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Airbus SE. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.